February 26th, 2024. I wanted to start off by mentioning that the context on the daily chart was, a little bit more bearish. So it made sense. I thought today's low was going to be a really important target because, this is a potential credible swing sell on the daily chart. You can see we had this channel line and we've been keep testing it, selling off, testing it, selling off. So we tested it. So I thought we might get some sort of sell off. Mentioned Friday, there was potential for a plunge on today. And, we didn't get a plunge. We got a broad bear channel. But, the thing is, let me gather my thoughts for a second. A lot of times you're not going to end up getting, the straight down plunge that you want. You can see we tried to get some sort of big sell off here. We got a breakout below what was going to be a bull flag, and bears were hoping for a big sell off, but there was so much trading range price action on the open. This is what I was trying to say. There's so much trading range price action on the open that you really have to manage your expectations for how far swings are going to go. If you look at bar 46, traders who sold below it, they made almost exactly 10 points, right? So it had to go 10.5 points for them to make 10. And during the low of 51 is where it hit that. So traders, they sold, but they knew it was probably a trading range and they scalped with 10 points. You can see traders were managing their expectations all day for, how far they thought trades were going to go. And it's really easy, to see this and be short and start to think, well, 50 is probably a minor reversal and I can hold through it and we're going to keep selling off. You might be right, but minor reversals in what are probably trading ranges, because this, it's a broad bull or a broad bear channel, but broad bear channels are still, types of trading ranges. Those pullbacks can be a lot deeper than you want them to be and a lot harder to hold through than you would think. Bar one, a bull bar, but a tail on the top and a tail on the bottom. So really not that good. I don't want to do anything here. Bar two, bad follow through, as expected. It's a double top with this, but I don't think I really want to sell. Then you get a good bear bar closing near its low on bar three. At this point, I think that probably 40% chance that this is the high of the day once you see bar three. Just given the context of the daily, that we might sell off a little bit more. So reasonable to sell below three and take a chance that we're just going to sell off all day. But if you take it, you probably have to sit on your hands through all of this. You can't really take, I don't think it's smart to take it and then just look to exit somewhere over here. Because the reality is, it's probably not going to go straight down and you're going to sit through a bunch of pullbacks. So if you sell three, that's probably the definition of a Walmart trade, and just go somewhere else for a bunch of hours and then come back at the end of the day and see if you've made money. And usually you won't. Which was one of the reasons I never liked Walmart trades. It's because I used to do stuff like that where I would, I think they made exactly, or a little more than 20 points. I used to do stuff like that where I'd take the trade and then I'd walk away for like an hour and then I'd come back. And if I got stopped out, I just felt really stupid. And so I stopped doing that. But reasonable thing to do. Bar four, you can see there's a big tail. And why? Because traders scalped. They know that this is a trading range. You can see we've been in this trading range for quite some time. And traders want to break out below the trading range and, eventually some sort of measured move like down here, which is pretty much exactly where the low of the day was. Something else that was important is if you look, the tail on four went up to here, and that's essentially traders' true risk. And if you take a 2-to-1 on that's basically exactly where traders scalped on four. So traders who sold below three made exactly 2-to-1 of their true risk and just scalped out. It was also around this close, so it made a lot of sense for them to exit. They know that four is probably not going to close on its low, and if four does close on its low, they can just sell again. So traders start to exit, and that's what's causing this. Traders, some traders hold through four and they're disappointed, so they take profits, causing 5. 6, essentially a low one short, but not very good. If we were going to sell off, we probably would have already gone. 7, obviously, you're not going to want to sell below 6. It's a tight trading range and a bad-looking sell signal bar. 7's a double bottom with 4, but really not that good. Tight trading range from 4, 5, 6, 7. And if you look, this whole thing is a tight trading range so far. So stop order is not really making any money. You can see that's why you end up getting bad follow through on 7, traders selling above, scaling in higher. And then, on 8, you get bad follow through. And then 9, a big bear bar closing near its low. But it's not breaking out below the bottom. So you could argue 9, double top 6, and you wanted to break out below the neckline, which is the 7 low, but you're not getting it on 9. Can you sell 9? You probably can sell 9, but this whole range right here was a mess for stop order traders. And the only way you can take, I actually did take a lot of these trades today. I don't think they were very good, but I did take them. But you can only take them if you're quick to get out. You can't buy above 10 and just get stopped out and then buy above 14 or 13 and get stopped out. Like the way I managed this today, and I don't even like the fact that I took these trades, and that was something I wrote that I need to work on, but I sold below 9 and then I saw 10, and as 11 dipped down, I exited around break even. And I did end up buying above 10, hoping that it was some sort of truncated wedge, 1, 4, 8. And then as 11 came back down towards my entry price, I just got out. Then I sold below 12, and as 13 bounced back up towards my entry price, again, I just got out. So I pretty much was break even through here, and then I bought above 14 and exited below that, or bought above 13 and exited below 14. But 13 is not a good buy. You're buying in the middle of a tight trading range, and you're buying right on the moving average. So it's just not very good. But my point is, you can't really, I don't like that I took them, but I thought I managed the first couple okay. And if you're going to take trades like this, you have to be really fast to get out. And most traders are not that fast to get out. And the worst thing you can do is sell below 12, put a stop above it, and then get stopped out on 14. So you really can't do that. If you're going to take a trade like this, you need to either have a really wide stop and be scaling in, or getting out, as the bar is bouncing. So anyways, 9, a bear bar closing near its low, but a couple legs down. So if you're going to sell this, you need fast follow through, and you don't get it on 10. 10, I thought potentially some sort of wedge, potential swing up, but let's see the follow through. You need good follow through on 10. And you can see, or on 11, and you can see traders don't get it on 11. And look what 12 does. As it rallies basically to the exact same price on some smaller time frame, there was a couple of bull bars closing near their high at 11, and then it became a trap. And 12 traded up and tested that price, and then you got to sell off again. So 12, bears want a breakout below the wedge and some sort of measure move down, and bulls want, basically this to fail and a reversal up. You can see if you sold below 12, you did get the breakout below the low of the day on 13, but traders immediately scalped it. So what does that tell you? That tells you that, we're clearly in a limit order market, and you can see that stop order traders have, losing trade. So it's better to just wait for follow through when the market's in a tight trading range. If you just decided to wait for follow through on this day, then you wouldn't have done anything until probably 16, and it's just a lot less stressful and a much easier trade to take. So 12, it's an inside bar. It's essentially a double top with 9. Bears want to break out below the 9 low, but more importantly, what they want is a breakout below the 4 low, and they want it to be successful and close near its low. And they get disappointment on 13. Traders might exit above 13, big bar, and right on the moving average. So not really a great buy for the bulls, low probability. And then a reversal down on 14. Traders who bought above 13 are now trapped. They have to exit below 14. Bears want follow through and a measured move down. They already highlighted. Bad follow through on 15, so not great, but always in short. That was another point I had, that I thought, we became always in short on 3. There was the gap up, but this was strong enough to make the market potentially always in short. But I thought it was back to always in short on 3. It's a trading range, so always, even though it's always in short, it can go sideways for a while. And while always in bears are probably going to exit above 10, they'll probably exit above 13. It never really clearly became always in long. So I thought, while the sells weren't great through here, the sells were better than the buys, because I thought that we were kind of always in short this whole time. We never really became always in long. If you look at it through the whole day, if you really think about it, I don't think we ever really truly flipped the market to always in long. We tried a few times, and we probably got close, maybe briefly always in long on 29, but then back to always in short. Maybe briefly on 35, but let's see the follow through. If 36 is a bull bar, we're probably always in long, but they don't get it. And then over here, potentially always in long, but what do you notice is that, with how strong this is, that this is going to be a minor reversal on 50. And so we're probably going to get a lower high. And when you get a big spike like this, the first thing you should think about is the fact that you're probably going to get a lower high. So if you're buying above this, it's very unlikely that we're getting up here. This is probably your first target, this low, since that's where the bears got trapped, or the bulls got trapped. So it was really, for the most part, stayed always in short today. Maybe some brief flips to always in long, but again, the sells were overall better today because we were more or less always in short the whole day. 16, follow through for the first time today. So 3 straight bear bars, 2 closing near their lows. Okay, swing sell below 16, but all the big bear bars, 3 bad follow through, 9 bad follow through, 14, it's not a big bear bar on 14, but kind of gets bad follow through 15. So do you think 16 is going to have great follow through? Probably not. It's probably going to get bad follow through. It's still always in short and okay, swing short, but I don't know if you got 2 to 1 here. Probably not. Almost exactly, but not quite. But bad follow through 17. So these bear bars are getting bad follow through, but we're slowly trickling down lower. Follow through on 19 and a doji bar, or on 18, but tail. And that, as I mentioned on the daily chart, the context was good, and we were probably going to get to yesterday's low. And what did bears want to see at yesterday's low? They wanted to see a strong breakout below it and basically a collapse, because on the daily chart, this isn't high probability short for the bears. This is a lower probability short. They want, we're probably going to get a couple legs sideways to down, but it doesn't mean we have to go straight down. And if they're betting on a plunge, they need the market to go straight down, and it's probably not going to do that. So they wanted to see huge bear bar closing near its low. But look at this trading, right? This looks like a leg in a trading range. Does this look like a bear trend, or does it look like a leg in a trading range? It looks like a leg in a trading range. So probably a trading range, and we get a doji bar on 19. And usually when you're in, a theoretically sell to close bear trend, which I suppose this was, but it was more of really just, it was traditionally more interested in selling pullbacks. But when you're in some sort of bear trend, which although it's a leg in a trading range, it's still a quote unquote bear trend, you know that we're probably going to end up getting profit taken within a few bars once you see a doji. And then you get 20, which goes to yesterday's low and starts to get bought back up. And as I mentioned, the context for the bears was okay for a swing down, but this was not all that good. So you knew there would probably be buyers at yesterday's low. And another point I wanted to make on bar 20 is like a minute into bar 20, like a minute and a half into bar 20, it was already on its low. So it was basically down here with 3.5 minutes left to go in the bar. What do you think is more likely? We're at a support point. So do you think it's more likely that this gets bought up into some sort of disappointing bar for the bears? You're also getting a breakout below this channel, right? So bears are getting a breakout below the channel. They want big follow through, and they're probably not going to get it. And what do you think is more likely, that this gets bought up into some sort of disappointment bar, or that this bar becomes, like 3 times its size and closes down here? Because you have like 3.5 minutes left in the bar when it was on its low. So do you think it's going to get all the way down here? Or is it probably going to be something disappointing? Especially with all this trading range price action, you have to be thinking it's going to be something disappointing. And that's what happens on 20. Traders see 20, they're disappointed. They buy back their shorts during 21. And then you get a bounce on 22. Again, I think it's mostly bears buying back shorts. They were hoping 21 was going to be a follow-through bar, a bear bar, but it wasn't. They buy back shorts, but limit order bears are willing to scale in here, knowing that any reversal up is probably minor. Do always in bears sell again below 23? Maybe, but you're selling low in a bear, kind of weak bear channel. It's a big bar. Your 2 to 1 is at least down here, if not all the way down here. So it's really not all that great of a sell below 23. Reversal up on 24, but not very good. With all the, look at all the bull stop orders today. Bad follow through, right? So any sort of bull stop, bulls haven't even gotten any really kind of consecutive bull bars besides this, but this is not, that's not something to be proud of if you're a bull, 21 and 22. So I think that, while 24 is, potentially a credible buy, lower low, double bottom with 20, it's a minor reversal and you're buying the top of a tight trading range. So it's really not all that great. And again, you have to be expecting a lower high from the 14 low. We might touch the 14 low, which is exactly where we went, but why the 14 low? Because it's a swing point. That was where the swing trade started. And so that's what we ended up testing. So a lot of times when you get, I'm trying to look for another example right now, but when you get the start of a swing trade, like we did here on 14, and it's a trading range, that low becomes a target because that's where, it was a low probability short below 14 and bulls who bought below got trapped. So it was low probability. Same way that breakout points here, like these lows end up being targets. And the 45 low I thought was a really important target because the bulls who bought below 45 got trapped on 46, never got let out. And then they didn't get let out all the way over here. So the bulls who bought below here were scaling in and waiting to get out here. So there's going to be sellers at the 45 low. So that's why that happened. But anyways, bad follow through 25, relatively expected in the tight trading range. And then a reversal up 26, bull bar closing near its high, but near the top of the tight trading range, near the moving average. Where did bulls buy? They bought a 50% pullback of bar 24 rather than directly above it. So instead of buying above the bar, like stop order bulls, limit order bulls instead waited and bought 50% pullback. And the stop order bulls were able to make almost exactly 2 to 1 of their true risk, which is really common on trading ranges. You see this everywhere, buying above 59, 2 to 1. Bang, that's where it went on. The true risk, I just mean, traders don't know where their stop had to be if they bought above, 59, and then you get the tail on 60. And so technically your stop only had to be 1 tick below here. And when it starts to race up and hits that 2 to 1, and why 2 to 1? Because that's a swing, a theoretical swing profit. When it starts to hit that 2 to 1, that's where traders take profits, and also the 45 low. So there's really a lot of reasons there were going to be sellers here, but there's this tail existed for a reason because computers knew that it was the 2 to 1 of the 45 low. So that's why they bought there. This wasn't random, but it's just creating more profit targets there. So 27, doji bar, follow through for the bulls, 28, and then a kind of climactic bar on 29. A little bit of a breakout above this channel, but it's not like something that bulls are looking at and they're thinking, wow, we're going to go so much higher. They would need a much bigger bull bar for that. Additionally, it's 1, 24, pullback 25, 2, 26, pullback 27, and then 3, 28, 29, climactic bar, inside bar closing near its low 30 and testing the low of that swing point. So do you sell 30? It's potentially a wedge pullback and you might get a second leg down, but I'm not really sure how good it is. This bull channel up from 24 to 29 is pretty tight. So probably going to be buyers, somewhere below here, maybe 5 points, maybe a little more. And then you get a follow through bar on 31. But if you're a bear and you sold below 30 and you start to get this, you're probably pretty thrilled with that. And you just take profits. And that's why there's a tail on 31. 32, an inside bar, low one short, but not really that good. And a bull bar on 33. Bulls want a trend line break and then a major trend reversal. Bears want this to be a bear flag and get some sort of double top like we did in a swing down. Do you buy above 33? I think that if you're going to get the major trend reversal, we're probably going to get another leg more sideways to down, and you're going to get an opportunity to buy lower. 34, a bear bar closing near its low, a low one short, but you're in the middle of a trading range. Bull bar closing near its high, 35, good for the bulls, but let's see the follow through. Bull bars seem to get bad follow through today. If 36 looks like 35, then you can buy. And you get disappointment on 30, 36. Traders sell out, causing 37. If you sell 37, it's a double top bear flag. When you get these double top bear flags, 40% chance you get a measured move down to here. So you can sell below. It's always hard to hold when you get these double top bear flags, but 40% chance that you get a measured move down from the neckline. So 30, 37, 40% chance that we get down to here. You get follow through 38, good for the bulls. Follow through 39, good for the bulls, but disappointment on 40. Essentially, potential second leg down 41, but then disappointment 42, midday reversal. And what does that make 43? A potential third push, right? So 1 pullback, 2 pullback, 3. And if you're going to get this bear breakout, is this how it's going to look? Do you think? Probably not. And so, selling the breakout here is not very good. I would wait to see if 43 closes on its low. And if 43 closes on its low, then you can sell. Or, better yet, wait for follow through. But what is 43? It's a doji bar. It's also a wedge, 4, 24, and 43. 3 basically pushes down, and it's a lower low major trend reversal attempt by the bulls. As you can see, we have the trend line break here, and then a retest, and then they want the major trend reversal. But it's a bear bar, and since it's a lower low major trend reversal, whenever you get a lower low major trend reversal for the bulls, generally going to need a higher low before you can get the reversal. So 43, not a very good buy. Good, decent context for the bulls, but just not a very good buy. Bad follow through 44 and bad follow through 45. So not a lot of interest in buying up here. And then you get a surprise. Then you get a surprise bar on 46. And I think 46 is an interesting bar. Bulls will buy below 45, betting they can scale in lower and make, end up making money. And what they want is, they see 46 and they know it's not good for them. So bulls will buy below 45, a bull bar, hoping that, we might drift a little more sideways and then get the reversal, hoping for that higher low. So bulls, after they see 46, want a trap and a higher low and then a swing up. But 46 is a really surprising bar, and it's a really strong bar. And we've still been always in short all day. And if you notice, we kind of keep selling off at the moving average, and we did it again here. So bears can sell 46 since it's always in short on, a day that's generally bearish, and they can sell 46 for a swing and hope for a measured move down. Maybe this, some sort of measured move down, and see what they get. If they get a bull bar closing near its high, they'll get out, and bulls might start to buy for that major trend reversal. But if they don't get the bull bar, bulls might start to panic out. And then you get just, I don't know if you guys noticed, but with like 10 seconds left in the bar, 47 was on its high. And then you got and then it immediately turned into a bear bar like that in like 1 second, because bears were selling it, desperately trying to make it a bear close. And the moment it closed bearish, I don't know if you were watching, but 48 just basically in the first 10 seconds was like down here. It just immediately sprinted down. And why is that happening? Because the bulls who were front running this move, right? They wanted this to be a bull bar closing near its high, but it ended up being a bear close. So they just sold out of their longs immediately, and that caused the drawdown on 48, or the initial move down on 48. No one wants to buy above this bear doji bar. Bears will probably get out a couple points above, knowing that we'll probably get back to the 45 low if we trade above 47. But realistically, we shouldn't trade above 47 if this is going to be a sell-off. And then you get the sell-off 48. Tail on the bottom, so maybe not as good as it could be, but still a bear move. I thought that looking at the daily chart, I still think this is going to be a magnet. So I think it's going to be a big support point, the high of here. Why? Because bears sold above this high, and they got trapped on this move. So we're probably going to get back to this high. So I would pay a lot of attention tomorrow to 5066.5, because I'd say that's probably going to be a pretty clear support point. But I thought we might get there today with the sell-off. I wasn't sure. Follow through 49 and then a reversal up 50. Do you exit above 50? I think so. Bears clearly scalped with 10 points. And again, you have to manage your expectations on days where, the market's trading like this. It's a lot of trading range price action, so you can't get too hopeful. Especially when you get a bull bar closing your tie, you're really pushing your luck if you're staying long or staying short there. So I think it makes a lot more sense to just get out above the bull bar closing your tie 50. It's like I said, it's probably a minor reversal, but it's also you might get a deep pullback here. Follow through for the bulls 51, a good bull bar, but I think that we're going to get a second leg down. Disappointment 52, low one short, but not closing very strong. So not as many always in bears willing to sell. 50 and 51 are probably strong enough for their own second leg, which you get 53. Follow through 54. This channel from 50 to 54 is really tight, so I thought it was okay by the close 54, looking to get back to the 45 low. Why the 45 low? Because this is trading like a trading range day. I know it's a bear move, but it's a type of trading range day. And so I think that the bears who buy below 45 are going to get out break even. You get follow through 46, but then suddenly or 56, 55, but then disappointment 56. And I think 56 is an interesting bar. You know that this pullback is deep enough that it's a reminder that this is clearly a trading range day, right? Bears didn't want to let the bulls who bought below here, these breakout points, and got trapped on 48, 49. They didn't want to let them out at break even on their first entry with profits on their scalings, but they ended up doing it on 54 and 55. However, we know that this is probably going to form a lower high and that this was probably strong enough for a second leg down. And this could just be a second leg trap. So I thought 56 was a credible sell, looking for a second leg down from here. But it's a sensitive trade because if you're going to sell 56, you need 57 to look the way it does. And if 57 is just kind of closing in here, you just need to get out of the market. So, if it's anything disappointing on 57, you probably just exit at the market. But I thought, okay, sell 56. You could probably sell below 57. It's always in short, but, I thought the odds of a bear trend decreased dramatically after this. So bears might be scalping. And they ended up scalping with 4 points here instead of 5 because the bars got a lot smaller. And later in the day, the scalps will generally get smaller. So bears ended up scalping with 4 points after 57 or after 56 and not 5. So they weren't buying or they weren't selling the 57 low, they were scalping out. I thought it's probably okay to hold through 57 and just see what you get on 58 because this is a big enough bar that sometimes you might get a collapse here. But I just, I'm not sure how much lower we're going to go because there's probably buyers below this low and there might be buyers at the 49 close. And you can see we touched the 49 close and we ended up finding buyers a whole bunch. Why? Because bears who sold the close at 49 are disappointed in this. Obviously, if you sold 49, you didn't want to see this. And so you're getting out around break even as fast as possible. 58, I thought was a credible buy as well. You know that any bears who sold down here are going to be disappointed in this, and they're going to buy back their shorts above 58. And bulls can buy above 58, betting that we're going to close the gap at the 45 low. Follow through 59, a big bull bar closing near its high, but probably going to get bad follow through because the big bar and the risk is big now. So the equation to the 45 low is not as good. Disappointment 60. And then you can see 61 traded right to the 45 low where we found sellers about 2 to 1 of their true risk. Or that was a bad. I know you have to buy one tick above 59. Technically, as you had to buy and get in here. But I've just found that, the math for just using the high of the bar and the low of here is always, it just seems to work a lot, or not the math, but the bars seem to obey those prices a lot more. So that's why I use those measured moves instead of the the ones from Al's course when he talks about actual risk. I think he calls it actual risk. I call it true risk, but it doesn't matter. 61, potentially a wedge. 52, 56, and 61. Couple legs up, so 3 pushes up. 1, 2, 3. Not a great sell, but I would be out of longs below it. I would have been out of longs up here. I would have gotten out of everything. You need to be, you got to scalp on trading range days, or you got to just get out at clear profit targets. Disappointment 62 because the tail, and more disappointment 63. Lots of tails. This is just going to go sideways. I would be out of everything at this point. More bear bars 64 and sellers above 64 during 65. Bear bar closing near its low 66, but could be 1 pullback 2 legs down. 67 a bull bar, but after this many bear bars, I don't want to buy. 68 a bull bar closing near its high, but again after this many bear bars, it's really hard to want to buy. If you do buy above 68 and you see 69, you need to flatten at the market because if you bought above 68, what are you hoping for? You're hoping for a huge bull bar on 69 and to get swept into a buy the close rally and cause some sort of vacuum test up and get back to like maybe the open of the day, maybe the I don't know, the 36 or the 35 close somewhere over here. Additionally, another reason it's bad to buy above 35 is because the bulls who put up the 29 close are going to be disappointed in this, and they're trying to get out. So you see 69, you just got to flatten at the market, and that's what causes 70. And then you can see essentially all this buying right here was just the 49 close. If you bought the 49 close or sold the 49 close, we're disappointed in this. And so every time it got there, traders kept buying back shorts. We had a couple bear bars into the close. What do I expect tomorrow? Low probability of just another big bear bar. Most likely, I'm really interested to see what happens at the high of 212. I think this will be an important price tomorrow. Whenever we touch it, we'll probably bounce for at least a couple of bars. But I think that, potentially if we start to trade down tomorrow, and I wouldn't be surprised if we get a reversal, maybe I don't know, I'm like super speculating right now, but, bar 18 is an important bar. So maybe, if assuming we open around this close and we trade below it and we start to trade down to this high, maybe we get like a reversal up on bar 18. Something like that wouldn't surprise me. So I would pay a lot of attention to this price tomorrow and see what happens when we get there. On the weekly chart, new week, again, that's that high. So I think we're probably getting back there. And it's towards the end of the month. Bears want to get as big of a tail on this bar as possible. Maybe pay attention to the midpoint of the bar if we get a sell off tomorrow. But generally, Bears just trying to put a big tail on this bar. All right, that's the day.